Hi, welcome to this quick tutorial about Treasury stock, otherwise known as stock buybacks. A company's own stock that it has issued and later reacquires is called Treasury stock. Many public companies spend billions of dollars each year to buy back their own stock. Treasury stock is recorded at its cost, which is the market value of the stock on the date it is purchased without regard to the stock's par value. Treasury stock is a contra stockholders' equity account. Therefore, the Treasury stock account carries a debit balance, the opposite of the other equity accounts. It is reported beneath the retained earnings account on the balance sheet as a negative amount. Corporations purchase their own stock for several reasons. One reason might be that the company has issued all its authorized stock and needs some stock to distribute to employees under stock purchase plans or compensation plans. Another reason is that the business may want to increase its net assets by buying its stock low and hoping to resell it for a higher price. Another reason may be that the business wants to avoid a takeover and is buying its own stock before someone else can. Another potential reason why a company may want to purchase its own stock back is that management wants to increase its reported earnings per share, EPS, of common stock. EPS is basically calculated as net income divided by the number of common shares outstanding. Purchasing shares removes them from outstanding shares, which decreases the denominator of this fraction and increases EPS. Finally, management may want to use a repurchase program to return excess cash to shareholders who are willing to sell their shares back to the company as an alternative to receiving a cash dividend. You may hear about stock buybacks. A stock buyback is when a company buys its own stock back, otherwise known as treasury stock. There are 4 types of treasury stock transactions. The first is buying treasury stock. Assets and equity decrease by an amount equal to the cost of the treasury stock purchased. The second type of treasury stock transaction is reselling treasury stock. Assets and equity increase by an amount equal to the sale price of the treasury stock sold. Another type of treasury stock transaction is retiring treasury stock. Treasury stock is removed from the common stock account entirely. Finally, the last type of treasury stock transaction is reissuing treasury stock for employee compensation. Expenses are increased, common stock is increased for the par value of the shares, and the additional paid-in capital is increased for the difference. There are 3 distinctly different numbers of a company's stock. Authorized stock is the maximum number of shares the company can issue under its charter. Issued stock is the number of shares the company has issued to its stockholders. This is a cumulative total from the company's beginning up through the current date, less any shares permanently retired. Outstanding stock is the number of shares that the stockholders own, that is, the number of shares outstanding in the hands of stockholders. Outstanding stock is issued stock minus treasury stock. Let's go through a simple treasury stock example to see the impact of a stock buyback on earnings per share. Here, Tobias Company purchased 500 shares of its own common stock at the beginning of year 2. The par value of each common share is 10 cents, while the price paid per common share purchased is $50. The total cash paid is therefore $25,000, which is the 500 shares times the $50 per share. Tobias Company would record this transaction as a debit to treasury stock for $25,000 and a credit to cash of $25,000. That treasury stock debit decreases stockholders' equity, while the credit to cash decreases assets. Let's look at the impact of that treasury stock buyback in year 2 over the time frame of years 1 through 3. Here we have listed the company's net income for each of those years. Ignoring any treasury stock purchase, we can calculate the earnings per share each year as the net income divided by the original number of shares, which was 1,000. So we see that earnings per share started out at $11.80, then dipped to $11.24, and then went slightly up to $11.54. Year 2 was definitely a down year in terms of earnings. Now let's factor in the repurchase of 500 shares of stock at the beginning of year 2. Instead of dividing the net income in years 2 and 3 by the original 1,000 shares, we divide by the 500 shares that remain, the original number of shares of 1,000 less the 500 shares that were repurchased. The earnings per share year 2 now is $22.47, which looks like the company did much better in year 2 than year 1, but it did not. Look at the overall net income trend. This example shows how stock buybacks can distort earnings per share for the uninformed user of financial statements. Okay, that's it. We're done. This video was created and narrated by Dr. Wendy Tietz. Have a great day.